Welcome, everyone. Today, we are diving into one of the most powerful tools in trading, and that is the volume indicator. We are going to explore the best settings you can use to boost your trading strategy and take your understanding of the market to the next level. Volume is a crucial element of understanding what is going on behind the scenes with price action. It helps you see what is driving the movement in the market. When you set it up correctly, it can make a big difference in how you understand what is happening with price changes. Are you ready to get started? Let's dive right in. Before we can dive into the advanced techniques, let us first understand why volume is such a game changer in trading. Imagine being able to peer through a window into the true activity of the market, seeing exactly how many shares or contracts are being traded at any given time. Think of it as a way to see the level of interest in a stock or market. The more people trading, the more powerful the moves can be. The volume indicator can help you figure out if a price trend is strong or if it might be ready to turn around. When you understand volume, you get a sense of whether buyers or sellers are really in control of the market. But here is something important to remember: the settings matter. Changing the settings can show you different details of what is going on, so you can get a better understanding that fits your style of trading. Stick with me here, because we are going to break it down step by step. Before we dive deeper into volume settings, let us also consider how chart patterns come into play. Chart patterns are crucial in understanding price action, and when combined with volume, they can give you a powerful edge. For example, if you see a head and shoulders pattern forming, paying close attention to the volume can help you confirm whether a reversal is likely. If the volume increases on the breakdown, it signals strong selling pressure, confirming the pattern. Similarly, for continuation patterns like flags or pennants, increasing volume on a breakout indicates that the trend is likely to continue. Another common pattern is the double top or double bottom. In these patterns, volume plays a key role in confirming a potential reversal. When the price tests the same level twice and volume decreases on the second test, it often indicates that the market is losing momentum and a reversal could be near. Conversely, if volume picks up when breaking through support or resistance levels, it shows strong interest and can signal a decisive move. Triangles are also popular chart patterns that traders look for. Symmetrical, ascending, or descending triangles can all tell you a lot about market sentiment. For example, if you see an ascending triangle with increasing volume as the price approaches resistance, it often suggests that the buyers are gaining strength and a breakout is imminent. On the other hand, if volume is fading, it could mean that the breakout may not be as strong or could even fail. Remember to always pair your chart pattern analysis with volume to get a better read on the market. Volume confirms whether the price movement you are seeing has enough strength behind it. Combining these tools will help you be more confident in your trading decisions and better anticipate what might come next. We will explore more patterns and how they fit with volume as we move forward. Let us start with the simplest way to use the volume indicator. Most of the time, your chart will have a default volume setting. It is easy to spot. Just look for the colored bars. These bars are usually green when the price is moving up and red when the price is moving down. It is a really straightforward way to get a feel for what is happening with the volume. If you are just getting started, this is a great place to begin. You do not need to make any changes to the settings. Just use what is already there and try to connect the volume with how the price is moving. If you see green bars getting higher, that means more people are buying and the price is moving up. If you see red bars getting taller, it means more people are selling and the price is dropping. Try it out and see if you can spot how volume lines up with price. Now that you have the basics down, let us take it a step further. Have you ever noticed how sometimes there is a lot of back and forth, and it is hard to tell if the volume really matters? That is where a moving average comes in. You can add a moving average to your volume indicator, which helps smooth out all the little changes that happen every day. By using a moving average, you can see more clearly if volume is increasing or decreasing over time. For short-term traders, a 20-day moving average works well, while a 50-day moving average is good if you want to look at longer trends. Adding this setting can help you avoid getting distracted by small spikes in volume and let you see what is happening overall. Let us also take some time to understand how different chart patterns can be paired with volume analysis for even greater insight. Chart patterns, when combined with volume indicators, can tell a very complete story about market sentiment. Let us look at a few common patterns and how volume fits into them. The first pattern we will explore is the head and shoulders pattern. This is a reversal pattern that often signals the end of an uptrend. When you see the head and shoulders form, volume is key in confirming it. Typically, volume will be higher during the formation of the left shoulder and the head, then decrease on the right shoulder. When the price breaks down through the neckline, you want to see an increase in volume. This confirms that sellers are stepping in, and the reversal is likely to be valid. Without strong volume on the breakdown, the pattern might not have the strength needed for a true reversal. Next, let us talk about continuation patterns like flags and pennants. These patterns indicate that the market is taking a short break before continuing in the same direction. In these cases, volume usually decreases during the formation of the flag or pennant, indicating consolidation. When the breakout happens, you should see a surge in volume. This shows that traders are stepping in to continue the trend, and it is a good signal that the price will keep moving in the direction it was originally headed. If the volume does not increase on the breakout, the move may lack conviction and could fail. Double tops and double bottoms are also very common reversal patterns. In a double top, the price tests the same high twice, but fails to break through. Volume often plays a key role here. If the volume is lower on the second peak, it suggests that buyers are losing steam and a reversal could be near. On the other hand, if the price breaks below the support level with an increase in volume, it confirms the pattern, showing strong selling pressure. Similarly, for double bottoms, you want to see lower volume on the second dip, followed by a surge in volume as the price breaks through resistance, indicating strong buying interest. Triangles are another important group of chart patterns. You have symmetrical triangles, ascending triangles, and descending triangles. For symmetrical triangles, volume often decreases as the price coils into a tighter range, indicating a pause in market activity. When the price finally breaks out, a strong increase in volume is needed to confirm the breakout. For ascending triangles, volume tends to pick up as the price approaches resistance, showing increasing buying interest. A breakout with high volume is a strong signal that buyers are in control. Conversely, for descending triangles, you want to see volume increase as the price approaches support, with a volume surge on the breakdown confirming that sellers have taken charge. Another interesting pattern to watch for is the cup and handle pattern. This is a bullish continuation pattern where the price forms a U-shaped cup, followed by a smaller consolidation that forms the handle. Volume typically decreases during the formation of the handle, indicating a pause before the next move. When the breakout above the handle happens, you want to see a significant increase in volume to confirm that buyers are stepping in to drive the price higher. Finally, let us touch on wedges, both rising and falling. In a rising wedge, the price moves higher but the trading range narrows, and volume tends to decrease as the wedge forms. This is often a bearish pattern, and a breakdown with increasing volume is a strong signal that the trend is reversing. For falling wedges, which are typically bullish, you want to see decreasing volume as the wedge forms, followed by a surge in volume on the breakout, indicating strong buying pressure. Combining these chart patterns with volume analysis gives you a much clearer picture of what is happening in the market. Volume helps confirm whether the pattern you are seeing is likely to play out as expected. Always pay attention to how volume behaves during the formation and breakout or breakdown of these patterns. By doing so, you can increase your confidence in your trades and make better informed decisions. But let us keep going, because there is even more we can do with volume. Let us talk about relative volume. This one is all about comparing today's volume to the average over the past few days or weeks. Have you ever looked at the market and wondered if the trading activity today is actually unusual? Relative volume can help you see that. It takes today's volume and measures it against the average volume over the past 10 or 30 days. This tells you if something different is happening. If you see that today's volume is much higher than the average, it could mean a big move is coming. It could be a breakout, or it could mean that the price might be about to change direction. Keep an eye on the relative volume if you want to spot when something unusual might be happening. Next up, let us dig into volume profiles. Now, this is a powerful way to see where most of the trading is happening. Instead of just looking at how much volume there is during a certain time, the volume profile shows you how much volume there is at different price levels. This can help you see where buyers and sellers are really battling it out. If there is a lot of volume at a particular price, that can be a key level of support or resistance. Most people use the default settings here, but it is a good idea to adjust the range you are looking at depending on the time frame of your trade. For short-term trades, you might want to look at daily volume profiles. If you are in a longer trade, look at the weekly profile. This setting can help you spot where the price is likely to react, because those are the levels where traders have shown a lot of interest before. Let us switch gears now and talk about unbalanced volume, or unbalanced volume as we will call it here. This indicator takes the volume on days when the price goes up and adds it together, then subtracts the volume on days when the price goes down. This gives you a running total that shows whether the volume is supporting the price trend. If the price is going up and unbalanced volume is also moving higher, it means there is strength in that trend. You do not need to tweak unbalanced volume too much, but you can add a moving average to it if you want to make it a bit easier to read. Use unbalanced volume if you want to confirm if the trend you are seeing is strong and if volume is behind it. There is another indicator that can help with volume, and it is called the accumulation or distribution line. This one shows you if money is flowing into or out of a stock, and it is based on both the volume and the price. When you see the accumulation or distribution line moving higher, it means traders are buying more and accumulating shares. If it is moving lower, it means there is selling pressure and traders are distributing shares. You do not need to make any changes to this setting, but it is useful to pair it with trend lines or other indicators to get a more complete picture. For example, combining the accumulation or distribution line with a moving average can help you smooth out the trends and make it easier to spot accumulation or distribution over time. Additionally, you can look for divergences between the accumulation or distribution line and the price. If the price is making new highs but the accumulation or distribution line is not, it could be a sign that the trend is weakening and a reversal may be near. Similarly, if the price is making new lows but the accumulation or distribution line is staying flat or moving higher, it might indicate that selling pressure is easing and a reversal could be on the horizon. This can help you see whether a stock is being bought up quietly or if there is a lot of selling happening behind the scenes. Another important chart pattern to consider when using the accumulation or distribution line is the ascending channel. An ascending channel forms when the price is making higher highs and higher lows, moving between parallel trend lines that slope upward. During an ascending channel, the accumulation or distribution line can help confirm whether the trend is likely to continue. Ideally, you want to see the accumulation or distribution line moving higher along with the price, which indicates strong buying interest. If the accumulation or distribution line starts to flatten or move lower while the price is still climbing, it could signal that the trend is losing momentum and a reversal might be on the way. The descending wedge is another pattern that works well with volume analysis and the accumulation or distribution line. A descending wedge forms when the price is making lower highs and lower lows, but the range between these highs and lows narrows over time. This pattern is often a bullish signal, indicating that a reversal to the upside could occur. When analyzing a descending wedge, look at the accumulation or distribution line to see if buying pressure is building. If the line starts to move higher while the price is still in the wedge, it suggests that accumulation is happening and a breakout to the upside is likely. Pairing this with a surge in volume during the breakout can provide even stronger confirmation. Price channels are another valuable pattern to analyze with the accumulation or distribution line. Price channels form when the price moves consistently between two parallel lines, either ascending, descending, or horizontal. The accumulation or distribution line can provide insight into whether the price is likely to break out of the channel or continue ranging. For instance, if the price is moving in a horizontal price channel and the accumulation or distribution line is steadily increasing, it may indicate that accumulation is taking place and the price could break out to the upside. Conversely, if the accumulation or distribution line is moving lower, it could signal distribution and the price may break down out of the channel. Incorporating these additional chart patterns with volume analysis gives a deeper understanding of market behavior. The accumulation or distribution line, combined with ascending channels, descending wedges, and price channels, can provide key insights into market sentiment and trend strength. By recognizing these patterns and confirming them with volume indicators, you can make more informed trading decisions and identify high probability opportunities. Let us also explore how other chart patterns work hand in hand with volume analysis for deeper insights into market trends. One such pattern is the rounding bottom, also known as a saucer bottom. This is a long-term reversal pattern that is often seen in the context of a bear market turning into a bull market. Volume plays a critical role in confirming this pattern. Initially, during the formation of the bottom, volume tends to be low as traders lose interest. As the price gradually rises, volume should start to increase, signaling that buyers are stepping back into the market. When the breakout from the saucer happens, a significant rise in volume is essential to confirm the strength of the new uptrend. Another powerful pattern is the inverse head and shoulders, which is a bullish reversal pattern. This pattern forms after a downtrend and signals a potential shift to an uptrend. Volume is key in validating this pattern. During the formation of the left shoulder, volume is typically higher, then decreases during the head formation, and finally, volume should pick up during the right shoulder. The breakout above the neckline must occur on strong volume to confirm the reversal, showing that buyers are truly stepping in and taking control. The falling and rising channels are also useful chart patterns. In a falling channel, the price is making lower highs and lower lows, and volume can help confirm the eventual breakout. During the channel, volume tends to be lighter, indicating a lack of strong momentum in either direction. When the price finally breaks out of the upper boundary of the falling channel, a surge in volume can confirm the start of a new bullish trend. In a rising channel, volume is often higher when the price is rising within the channel and lighter during pullbacks. A strong breakout of the lower boundary with increasing volume can confirm a bearish reversal. Lastly, let us talk about rectangles or range patterns. These form when the price moves between a consistent support and resistance level, creating a box-like shape on the chart. Volume analysis is very useful here to understand whether the price will eventually break out or continue ranging. During the formation of the rectangle, volume usually decreases, showing a lack of enthusiasm from traders. However, when the price approaches the support or resistance level for a breakout, you want to see an increase in volume. A breakout with high volume confirms that traders are stepping in and that the price is likely to move out of the range with conviction. By incorporating these additional chart patterns and understanding how volume behavior can confirm or contradict price action, you will gain a stronger grasp of market dynamics. Recognizing these patterns and pairing them with volume will not only help in spotting potential trading opportunities, but also in avoiding false signals. As always, practice and consistent analysis will help you become proficient at identifying these opportunities in real time. Now, let us talk about the best time frames for using these volume settings. If you are trading on a very short-term basis, like intraday trading, you will want to use shorter time frames. Look at 5-minute or 15-minute charts and use volume profile or relative volume to catch early signals. If you are trading over several days or weeks, known as swing trading, use daily or 4-hour charts. On these charts, the moving average and on-balance volume can help you spot the bigger trends. And if you are looking at long-term investments, you will want to use weekly or monthly charts. Combine these with the volume profile and accumulation or distribution line to see the broader picture. It is important to match your volume settings to the time frame you are working with so you do not get mixed signals. Before we wrap up, let us quickly go over some common mistakes people make with volume settings. One big mistake is making things too complicated. You do not need to constantly change your settings or try to make them perfect. Often, the simplest settings work just fine. Another mistake is ignoring big volume spikes. Even if you are using a smoothed out moving average, do not forget to pay attention to those sudden spikes in volume. They often mean something important is happening. And finally, always make sure that your volume settings match the time frame you are using. What works on a 1-minute chart might not work on a daily chart, so adjust them accordingly. To sum it all up, the best volume settings really depend on how you trade. If you are looking for something simple, stick with the default settings. If you want to smooth things out, add a moving average Use relative volume to spot unusual activity and the volume profile to find key price zones. Start setting up your volume indicator, try out these different settings, and see how they work with your trading style. And remember, practice is key. The more you practice, the better you will get at understanding how volume can help you make better decisions in your trades. As you experiment with these settings, feel free to ask questions or share your experiences. There is always more to learn, and hearing different perspectives can help everyone improve. Now let us go out there, set up those volume indicators, and see what insights they can bring to your trading strategy. Keep practicing, stay curious, and happy trading.